All right, so in this video, I'm going to talk a little bit about interest rate components. So the basic idea behind this is that we can break up the nominal or quoted interest rate. So that's the interest rate you typically think of as being the rate associated with a loan. We can break that up into component pieces. Kind of like on a test, if the test had a multiple choice component, a short answer component, and an essay component, when you get a grade on the test, you would have a grade for, you could look at your grade perhaps on the multiple choice piece, your grade on the essay piece, your grade on the short answer piece, and together they make up your overall grade. So that's kind of what we're doing with interest rates. We're breaking the overall interest rate down into pieces. And so let's talk about what those pieces are. So first off, in this equation that I have here, R is going to be the quoted or nominal interest rate, sometimes known as the annual percentage rate or APR. So that's the overall rate. And that's going to be sort of approximately made up of several pieces. Sometimes I've actually used an equal sign here. And as long as the inflation rate and things like that, the interest rates involved are not too large, pretty much you sort of view them as more or less equal. But if you start having some really high inflation, things like that, then this turns into a little bit more of an approximation. But basically due to compounding. But let's kind of work our way through the pieces. So we've got R star. So R star is going to be the real risk-free rate. This is the rate that you would charge someone in a completely perfect world. So if you, let's say you had some money and you were about to buy a candy bar, you really wanted to buy a candy bar. You just really had a craving for that candy bar. And so you're about to buy that candy bar and somebody walks up to you and says, "Hey, will you invest your money in my business opportunity?" So if we're in a completely perfect world, meaning that you know this person's going to pay you back, there's no inflation, so no risk of default, no risk of inflation, none of that. You know for sure getting the money back, but you're going to have to wait, let's say, for a year to get the money back. Well, you have to wait for a year to buy your candy bar then, and so you're going to basically require that the borrower compensate you for this waiting. And so the amount that you would make that borrower compensate you, the lender, for waiting for a year to get your candy bar. That's the idea behind R star in my little example here. That's the real risk-free rate. Now, that was in a completely perfect world with no risk, no inflation, complete certainty you're going to be repaid, etc. So now let's add in a little bit more uncertainty. Let's incorporate inflation. So inflation is basically accounting for the fact that over time things are costing more. So if I lend you money over for a year, one of the things I need to factor in is the fact that when I get the money back, it won't buy the same amount of stuff because of the fact that things are going to cost more in a year. So I'm going to estimate what I think that level of inflation is going to be over the period of the loan, and then I'm going to incorporate a charge for that to the borrower to ensure that A, I get enough money back to buy whatever it was I wanted to buy before, B, I get some compensation for waiting, and C, make sure that we've accounted for the fact that things are going to actually cost more. So basically, the inflation premium is counting for the expected level of inflation. So a little note here. So when the loan is made, if it's a fixed rate loan, let's say a financial institution thinks that inflation is going to be 2.5% over the next, say 5 years, and let's say it's a 5-year loan. So they incorporate a 2.5% inflation premium. If inflation turns out to be 5% over the 5-year period, that's bad news for the financial institution because they're getting dollars back that have markedly less purchasing power than they expected, and they didn't charge enough interest to compensate them for that. So if inflation turns out to be higher than expected, that's bad news for the lender. If it turns out to be lower than expected, that's actually good news for the lender. Okay, but of course, going into it, we don't know which way it's going to play out. All right, so now we're going to make the world a little bit less perfect in my little example, and let's incorporate the possibility that the borrower may not repay the lender, and that's where we get the idea of the default risk premium. So for the default risk premium, this is going to be default is when the borrower doesn't pay something the way that he's supposed to. So he doesn't pay interest or principal, or some component of the loan agreement is not paid the way that it's supposed to be paid. So with the default risk premium, the lender charges more the higher the estimated risk of default. So if I am lending money to somebody and I think that they have a higher risk of default, maybe they have a lot of debt already, they don't have a particularly stable job, they have a history of not making payments. The history of not making payments basically means that that's sort of a history of default. So if that's the case, then I think that's a higher risk, and therefore, if I'm the lender, I would tend to charge more interest to compensate for that risk to me as the lender. Now, if you're thinking and you're kind of thinking ahead, well, if the borrower doesn't actually pay, then how exactly does the lender get that compensation with that default risk premium? Well, there are a couple ways that could play out. So first off, a person who is the borrower could make payments for a period of time and then they go into default and stop making payments. So the default risk premium that the lender received during the period of time when the person was making payments can help to offset at least some extent the lack of payments later. So there is something to be said for that. But also we have to keep in mind that going into a loan situation, a lender doesn't know with certainty who's going to pay and who's not. So really what a lender is doing is making a probabilistic assessment based upon various factors, perhaps financial condition, history of prior repayments, etc., of what borrowers appear to be at higher risk of not paying, going into default. And basically they charge those borrowers more interest. The borrowers that appear to have a lower risk of default, they charge less interest. Now, again, the lender doesn't know in advance really what's going to occur. So once things actually play out, sure enough, somebody winds up perhaps not paying, maybe others do. And if the lender has charged appropriate premiums relative to the risks across the whole pool of loans, then the idea is basically this works out enough for the lender that they get compensated for that risk overall, even though somebody doesn't pay at all, maybe everybody else does. And so in aggregate across the pool, by trying to charge higher interest for the higher risk of default, basically the lender gets essentially made whole in that sense. Now, if the lender does a bad job of judging the risk of default, then that may not work out, and the lender may not recoup the costs. So that's a risk if you're a lender, that's for sure. That brings us to LP, which is the liquidity premium, and that's accounting for how liquid the investment is. So let's go back to that example. Let's say you really wanted to buy a candy bar and it was sounding really good to you and you wanted to buy it. And maybe I'm the person that walks up and says, I want to borrow the money instead. So if you lend me the money, then you're expecting to get it back in a year. Well, what if you get 6 months into this loan and you decide, you know what, that's it. I've waited 6 months for my candy bar. I really want my candy bar. I just can't stand to wait longer. I really want the candy bar now. Well, what you could do at that point is you could try to take the loan and sell it to some other investor so that you could, in effect, get out of the loan early. And then if I'm the one who borrowed the money, I would pay that other investor back at the end. You would have cashed out midway through the year, and then you can go buy your candy bar. Now, if there's a big market for these loans, and it's very easy for you to sell this loan to somebody else and to recoup full value and your appropriate portion of the interest for the half of the year that you've had the loan and everything that you made the loan, etc. Then if that's very easy for you to do, then this is considered liquid. On the other hand, if it turns out you were like pretty much the only person who's willing to lend, let's say it was me, that money, and there is no market for these loans, and basically it's going to be extremely difficult for you to sell this loan to anybody else to cash out partway through the year, and that would mean if you lent me the money, you're kind of stuck with this loan, or you're going to face nasty losses trying to get out of it. So that would mean it would not be very liquid. So if it's a possible situation where it'd be very difficult for you to sell this security to somewhere else, this loan to somebody else, then that's going to mean you're going to charge a higher liquidity premium for that scenario. To give you an example, federal treasury bills are short-term loans to the federal government, and there's a vast market for these. A huge amount of these change hands on a daily basis, so they're extremely liquid. And so as a general matter of practice, those are assumed to pretty much have virtually no liquidity premium associated with them because it's so easy to sell them at full value pretty much at a moment's notice. If, however, you lent money to a small business that only operates in a certain region of the country, then there isn't nearly as much of a market for that loan. This is going to be harder for you to sell that loan to somebody else if you want to cash out as a lender partway through the year. So that would have a higher liquidity premium. All right, let's talk about the maturity risk premium. So the maturity risk premium is a component that's added to the interest rate that is accounting for the net effect of interest rate risk and reinvestment rate risk. So let's talk about those two pieces. So interest rate risk, this is basically due to the price effect of market interest rate changes. So if I borrowed money from you and you basically lent me money at a certain specific interest rate, let's say it was 10%, given all the risks, you concluded 10% was an appropriate rate. And tomorrow, the interest rate in the marketplace for a loan of similar risk shoots up to 15%. You are actually going to be rather sad that you made this loan to me at 10% because you could have got waited a day and gotten 15%. So what would happen in that case is the loan you made to me would actually become less valuable to you, less market value. And so as a result of that, this would be interest rate risk. It would mean market rates changed, and all of a sudden you find yourself holding a loan that you made to somebody that doesn't look like a good deal anymore. On the other hand, if interest rates in the marketplace drop, so let's suppose you lent me this money and charged a 10% rate overall, and then for whatever reason you wake up today, market interest rates have changed, and the prevailing rate for this type of loan is now 3%. Well, you're gonna be thrilled that you locked in a loan to me at 10%, because you're gonna be collecting 10% when everybody else in the market's getting 3%. So basically what that means is when market interest rates go up, that kind of makes the loan that you have already made look less attractive. And when market interest rates go down, it makes the loan that you've already previously made look more attractive to you as a lender. Now, on the other hand, we have reinvestment rate risk. So this is also related to market interest rate changes, but it's focusing on the income effect. So let's talk about that. A lot of loans are multiple year loans. So think a 30-year mortgage for instance. So let's suppose you're a lender and you have lent money to somebody for a 30-year mortgage. You're getting payments every month. So if you're getting payments every month, what you're going to do is as you get those payments every month, you're going to take those payments and you're going to reinvest them as the lender. Well, if market interest rates go up, you are able to reinvest that payment you get every month into something that's producing a higher return, which means as interest rates go up, it's better for you. You can reinvest those payments at a higher rate. On the other hand, if the interest rates go down, as you get a payment every month, you have to reinvest at kind of a worse rate. So what the reinvestment rate risk is focusing on is as you receive income from a loan as a lender, you are reinvesting it, and what happens to market rates changes how attractive that reinvestment is. And so what's interesting with the maturity risk premium is that we have these two interest rate effects that are linked to market interest rates, but they're kind of pointing in opposite directions. Let me explain what I mean by that. So for the interest rate risk, if the market interest rate goes up, it makes the bond that you are holding or the loan that you previously made as a lender look less attractive because basically that higher interest rate is available in the market, but you're locked in at a particular rate, so it doesn't look so good to you. However, because the market interest rates went up, as I receive a monthly payment, for instance, from the loan, I can now reinvest it at a higher interest rate, which actually is kind of nice. So that's kind of a benefit. So basically, when market interest rates go up, there's one aspect of it, the fact that the price of the loan that I made is going to go down, which I don't like. But on the other hand, any interest payments I'm receiving, I can now reinvest at a higher rate, which I do like. So they're kind of pointing in opposite directions in terms of whether or not this is a net positive for me as the lender. Now, on the other hand, if interest rates drop, I kind of get the reverse. So if the interest rates drop on the interest rate risk side of things, I am thrilled that I had made a loan previously because I locked in a rate when interest rates were higher. That's fantastic. We love it. That's great. However, slight bad side here. As I get interest payments every, say, 6 months, or every month, depending on the type of loan, whether it's a mortgage, a bond, whatever, as I get interest payments, I'm now reinvesting them at worse rates, which I don't like. So basically, those two effects are, again, pointing in opposite directions. So for the maturity risk premium, basically what it's capturing is there are effects from market interest rate changes on a loan. So if you're a lender, market interest rate changes affect kind of how attractive the loan is. And the interest rate risk and the reinvestment rate risk point in opposite directions. And what that ultimately means is loans with different characteristics, like different frequency of payment, different size of monthly payment or semi-annual payment or whatever. So loans with different structures have different levels of exposure to the interest rate or reinvestment rate risk. And because they point in opposite directions, the level of exposure to the two different factors affects how that factor ultimately affects the specific loan. But in general, something to kind of keep in mind is this is all driven by market interest rate changes. And the longer the period of the loan, the more uncertain we are about what those changes are going to be. So that brings us to kind of the last little point here. So if you're looking at the length of the loan, let's talk about these factors a little bit. So let's say you're lending money over 2 days. If you're lending money over the 2 days, you have a pretty good idea what inflation is going to look like over the next 2 days. Probably nothing too crazy is going to occur over 2 days. If I do 2 months, it could be a bit more. Over 2 years, well, we could have some inflation over 2 years, and it could be unexpected. Over 20 years, who knows, right? All kinds of things can happen over 20 years. For default risk, well, probably I don't think the company I'm lending money to or the person I'm lending money to is going to go into bankruptcy or default in the next 2 days. If I thought that, I probably wouldn't lend them money. So the default risk for a loan over a short period is probably pretty low. I have a pretty fair idea of what their financial situation is. So probably that's pretty low. Over 2 years, companies and borrowers, their financial situations could change over 2 years. So probably default risk premium is going to need to go up as the length of the loan gets bigger. And again, over 20 years, I mean, whole industries have changed drastically over 20 years. So the longer the period of the loan, probably the bigger the default risk premium is going to get. Maturity risk premium, that's due to market interest rate changes. Market interest rates could change all over the place over a long period of time. Probably not too likely to change too drastically in the next 48 hours. So the longer the period of the loan, probably the inflation premium is going to get bigger. Probably the default risk premium is going to get bigger. Probably the maturity risk premium is going to get bigger, basically because there are more uncertainties about what's going to happen. And that will come into a kind of more clear focus here in the next video about the term structure of interest rates. Now, as a little side note, I mentioned treasury bills previously. So basically, treasury bills are short term and are viewed as having basically no risk of default because the federal government could basically print the money to pay it if they had to. And there's very liquid, so they have low liquidity premium. So oftentimes treasury bills are used as an approximation for the RRF. So the RRF is the sort of the nominal risk-free rate. Okay, so the nominal risk-free rate. So for the nominal risk-free rate, we take the real risk-free rate plus the inflation premium. So the real risk-free rate is focusing more on like the purchasing power side of things, but we factor in inflation because we know they're going to have inflation. So we factor that in, we get the nominal risk-free rate, and that's the RRF. So the R star, the real risk-free rate, plus the inflation premium is the nominal risk-free rate. Oftentimes, we will use a treasury bill as an approximation for what that nominal risk-free rate is. Okay. Hopefully this video has been helpful. Thank you so much for watching and have a great day.